Property prices are sky high, demand for property is also sky high, but could we be heading towards a housing crisis? In this video, I want to share with you 6 key factors that could cause a housing crisis. If you're watching my videos for the first time, my name is Saj Hussain, and on this channel I share with you my 15+ years of property investing experience to ultimately help you get further faster in your own property investing business. In this country, we're just obsessed with property, whether that's home ownership or whether that's investing in property. And often that's fueled by either easy borrowing or low cost borrowing. And right now, even though interest rates are rising, we still have both of those. I remember around 2008 when I was fairly early in my property investing business. At that time there was a recession on, property prices had fallen quite significantly, and what I was doing at that time was trying to find good deals to try and sell on to other people. Now some people were very fearful, they didn't want to buy, they were concerned the market was still falling, but from other people there was still an appetite to buy, they were hungry to buy property because there's always been this fascination for property. However, the challenge was lenders were pulling their products and making it much more difficult to borrow money, and also interest rates are still quite high, which made it very difficult to purchase property, which is why for a number of years property prices stayed quite low. However, as we head into another recession now, things are very different this time round. So let's jump straight into the first of the factors that could cause a housing crisis. And the first is house prices versus salaries. About 10 years ago, in the middle of 2012, the average house price was about £170,000 and the average salary was about £26,500. So what that means is the average house price was nearly 6.5 times the average salary. When we compare that with this year, the average house price now is £283,000, with the average salary being about £31,500. That's a staggering 9 times the average salary. It's never been so high, this multiplier. For many years, it was only about 4 times salary. I remember my father, when he bought our first family home back in the 70s, he paid barely over £10,000 for that house, which seems staggeringly low by today's standards. However, the salaries are also very low at that time as well, but it was still around 4 times average salary in terms of the value of the property. Essentially what this means is it's becoming more and more unaffordable to buy that property, especially if you're a first-time buyer. Being able to get onto the property ladder is becoming more and more difficult, and if you're in London, it's even more painful. Those that purchased properties many years ago and now have them unencumbered, i.e. no mortgage on them, they're sitting in a very favourable position. But for those starting out and trying to get onto the ladder, things are looking very bleak. The next key factor is rental prices versus salaries. If we use the same 10-year time frame, rents about 10 years ago were about £660, and with the average salary, as I mentioned earlier, about £26,500, and essentially what that translates to is on average a third of someone's salary was going towards their rent. If we look at this year's figures, the average rents are now nearly £1,100, with the average salary being about £31,500. What that means is wages are now 2.4 times of salary. Ultimately, what that translates to is now more than 40% of someone's salary is being used just to keep a roof over their head. Again, what this means, the basic need of housing is becoming more and more unaffordable to most people. As a landlord, it could be seen as good news because you're getting higher rent from that property. However, we need to be mindful that the tenants can actually maintain their affordability, i.e. can they afford to pay that rent in the long term. Key factor number 3 is inflation. The consumer price index, the 12-month rate, is showing at 9.4%. However, this is often seen as not really in line with true rates of inflation, which can feel significantly higher. Many people right now are paying significantly more for products and items than they were a year ago. The major challenge we have right now around inflation is the increasing cost of necessities such as fuel and food. These are things people can't really cut back on. They're things that they have to pay for, and it means they're ending up with significantly less in their pocket by the time they're paying these extra costs. High inflation often leads to a slowdown in spending and also an increase in unemployment. None of these things are good for the economy and often make a recession much worse. Many people will see inflation as a bad thing. However, smart investors understand by actually acquiring assets during inflationary times means that your asset will be worth significantly more in the near future. But very few people tend to understand this. In fact, I have a video that I have on the topic, I'll link up here for you to watch afterwards. The next key factor is interest rates. At the time of recording, they're at 1.75%. We've just had a 0.5% increase in the Bank of England base rate. That's been the highest increase for a very long time. In fact, the last time it probably increased that much, I was probably still at primary school. The current rate is now the highest it's been since 2009. However, we need to put this into context. Rates are still exceptionally low. At 1.75%, they are not really representative of what you'd consider normal rates. So when I first got involved in property, a lot of the calculations we used to do on the deal analysis, looking at those deals, we used to do calculations at 6, 7 and maybe even 8% to be able to work out see if a deal was going to be viable, because the cost of finance was significantly higher. However, many people getting onto the property ladder now, buying their first home, don't realize that rates now are not really reflective of normal interest rates. If right now the rates were to go back to the average rates, there'll be some people that are pushed into financial difficulty straight away. If we consider that the average house value is about £283,000 at the moment, and if they're to purchase that on a 90% mortgage, that means they're borrowing £254,000 approximately. Their monthly mortgage payment at 2% would have been about £1,200. But now at 5%, that would jump to £1,673. So that's a difference of over £500 on the average mortgage repayment. We've been talking about average salaries in this video, and they tend to be gross figures, but once the deductions are made, the tax and various other things, the net figure can be very different. If we look at this chart, the gross average salary of £31,400, you'd have deductions of tax of around £3,700 and national insurance about £2,500. That would mean a net take-home pay of about £25,000 or just over £2,000 a month. So taking the average property purchase price with a 90% mortgage at an interest rate of 5% with an average salary, that would mean the average person has less than £400 to spend on all of the expenses after paying for the roof over their head. That does not make sense and certainly isn't sustainable. Factor number 5 is the price of fuel and energy. We talked about the high rate of inflation right now and how that's impacting people, and often the government has a tool it uses to try and control inflation, namely interest rates. However, the crisis around fuel and energy is a global one that's beyond the control of this government. And what that means is that they're very limited in terms of what they can do to try and get energy prices under control. And these energy prices impact all aspects of life. This is not just your gas bill, your electricity bill, your petrol, your diesel in your car. This is, for example, the cost of getting food transported to the shelves of the shop. As these costs have gone up significantly, the retailers can't absorb these, so they're passed on to the end buyer. Domestic gas and electricity prices have risen quite significantly. We're all aware of the huge increases in the price of gas and electricity. About 12 months ago, the average utility bill would have been about £106. This year, it's expected to be about £266 a month. That's an increase of over 250%. Very few people can absorb those kind of increases, especially the poor amongst us within society. Final factor number 6 is the supply and demand of property. This is really basic economics. If the supply is limited, then the demand goes up. As the demand goes up, the price goes up. But if the supply is increased, demand will reduce. And as the demand reduces, prices reduce. Right now, we're in a market where there's a huge demand for property with very limited supply. So prices are high. However, that's all slowly starting to change. We've now just come through the summer period. The market generally tends to slow a little bit anyway. And over the next few months, I'm sure we're going to start seeing an ease in the property market. What I mean by that is property is going to take much longer to sell. They're not going to be selling as quickly as they are now. Right now, the for sale sign goes up and then it's slapped on immediately by the sold sign. That'll slow down a little bit. It'll take a little bit longer to sell property because people are going to be more cautious about making those big financial decisions, because they're going to start feeling more and more pain in their pocket and in their wallet. Those decisions around purchasing the first home, or moving up the property ladder for a second home, or buying an investment property, they'll get put on the shelf because they will no longer be a priority. And as that demand starts to drop, we'll also see an increase in supply as people are still continue to try and sell property. We'll start to see a slowdown in prices, if not a fall. We need about 250,000 to 300,000 new homes each year in this country, and we're only building about 160,000. In fact, we never got close to reaching the target of 300,000 in any year. The government is constantly talking about changing this and making a difference to these numbers. However, when we break it down and we try and understand why is that the case, well, developers are keen to build. There are lots of developers that are quite happy to build and provide new homes. They've got an appetite to do that. And there's also people that are hungry for new homes. They want the homes. The demand is there for them. So what's stopping them? What is it that's preventing those numbers being reached? Well, ultimately it comes down to the government, because they control the planning system in terms of what you can build, where you can build it, and how that can be built. Without any relaxation or easing of that planning system, then we're not going to be able to meet the targets that we need. Although we're soon to have a new Prime Minister and we're yet to see what they're going to do, the reality is it's unlikely they're going to be making any massive changes there. And what this means is continued pressure on the housing market of limited supply. As the situation continues to get worse, it will increase the demand on social housing. And when we look at social housing, the government also has a limited supply of that. Back in the early 80s, they sold off much of their stock under the Right to Buy scheme. And yes, this was great for the local authorities at the time. It put money in their coffers. However, they didn't reinvest back in property, and now they have very limited amounts of property available. There's so much more that the local authorities can do to help developers to build more homes. Developers are also facing challenges around the increasing costs that we've been talking about earlier in this video. They're suffering around material costs, things costing significantly more. Mainly the projects we're doing right now, we're spending way more money to be able to get those renovations, those builds done than we were, say, 18 months ago. When we take a step back and consider these 6 factors, there's enormous challenges around increasing costs and affordability. This is going to ultimately mean that people are going to be in much more financial difficulty than they are right now, or have been in for a long time. Repossession rates right now are very low, but I can see those starting to increase quite significantly as people can no longer afford their homes. At the same time, there's also landlords that are feeling pain and pressure due to the constant changes in regulation and how they can operate as a landlord, which means many of them are really thinking twice about whether they should even be in the market and throw in the towel. This all seems to be painting a very negative picture. But does that mean as property investors that we should now be running for those hills, battening down those hatches? No, absolutely not. One thing I learned quite early is the only certainty in property is constant change, and we need to adapt as the market adapts. It will present new opportunities and different opportunities ones maybe you weren't aware of before. It's really being prepared to seize those opportunities to help people who may need to sell their properties so they can end up in a better situation. Also, you can benefit by helping them as well. This will also mean I'll be using those strategies I haven't used for a long time, getting them out, blowing the dust off them, and starting to implement those strategies that work in this particular market. If you've enjoyed this video, then do click on my face over here to subscribe to the channel. And before you go on that shopping spree to buy those property, you probably need to consider how is you going to fund those deals. Then make sure you watch this video over here that shows the many different funding opportunities available.